We all get excited about big tech IPOs, right? They're supposed to be a sign of a healthy market. But what if the next wave of IPOs is, well, so huge it could actually suck the cash right out of the market and drag your portfolio down with it? Yeah, let's dig into this so-called trillion-dollar trap. Okay, so let's just imagine for a second. What if the biggest IPOs in history, the real giants, all decided to go public at the same time? And look, this isn't some sci-fi scenario. Given the companies waiting in the wings, this is a very real possibility we need to think about. And who are we talking about? Oh, just the titans of the private tech world. You've got OpenAI, the brains behind ChatGPT. You've got Elon Musk's SpaceX, which is already valued like a blue-chip company. And then there's Anthropic, another massive player in the AI space. Look, when companies this big go public, they don't just, join the party. They have the power to completely reshape it. So when you put them all together, their arrival on the public market asks a really, really big question. We're calling it the trillion-dollar question. Could their success actually break the market? Okay, so here's the absolute heart of the issue. The amount of money these IPOs would require is so enormous, they could literally drain more cash out of the stock market than all the new money that usually flows in over an entire year. Just think about that for a second. More money out than comes in annually. Right, you're probably thinking, how is that even possible? Well, the answer is kind of hiding in plain sight. It's this quiet but incredibly powerful engine that drives a huge chunk of the market, and its hand would be forced. I'm talking about the passive index fund. Now, if you're not a Wall Street wizard, no worries. Let's break this down real quick. An index fund is basically an automated investment. It's not trying to be clever and pick winners. Its one and only job is to buy and hold every single company on a specific list or index, like the super famous S&P 500. And we're not talking about some niche boutique investment here. No way. We're talking about financial giants. Think Vanguard, think BlackRock. They manage trillions with a T of our money, our retirement savings, our investments through these exact kinds of funds. So how does it work? Well, the process is actually super simple. And more importantly, it's non-negotiable. First, an index like the S&P 500 creates its shopping list of the biggest companies. Then, and this is the absolute key, the fund has to buy every single stock on that list. It has zero choice in the matter. And finally, your 401k or brokerage account buys shares of that fund, and boom, you own a tiny piece of that whole shopping cart. All right, so you see what's happening here. We've got these monster IPOs on one side and these giant, super rigid, rule-bound funds on the other. When these two forces collide, it kicks off something we're calling the Great Portfolio Reshuffle. So take a look at this. This is more or less what a typical S&P 500 index fund looks like today. You see the big names, right? Apple, Microsoft, Amazon. These are the heavyweights that have been the bedrock of the market and probably your portfolio for years now. But now, watch what happens when giants like OpenAI and SpaceX go public. Poof. This visualizes the problem perfectly. Because they're instantly some of the biggest companies out there, the index rules say they must be added. And they don't just get a little sliver. They barge in and take a massive chunk of the entire pie, forcing this huge, dramatic change. And that leads to the million-dollar question. Or, in this case, the trillion-dollar question. Where does the cash to buy all these new stocks come from? Because these index funds, they're not just sitting on a giant pile of cash. The answer is painfully simple. To buy the new guys, they are forced to sell the old guys. And I really want to hammer this point home. This is not some fund manager making a savvy strategic move. It's not a choice at all. It is a 100% automatic mechanical rebalancing. The fund is just a machine following its programming. Okay, so a bunch of funds rebalance. Who cares, right? It sounds like some technical Wall Street jargon. Well, you do, because this is exactly where we start to see the ripples hit your own portfolio. This chart right here, this is the aha moment. That tall bar on the left, that's how much cash the index funds will need to buy into these new mega IPOs. And that tiny little bar on the right, that's the typical amount of new money that flows into the entire US stock market over a whole year. Look at that mismatch. It's staggering. It's like trying to fill an ocean with a garden hose. So what does this liquidity crunch, this massive cash shortage, actually mean for your investments? Well, for one, all that forced selling could start pushing down the stock prices of the good old reliable companies like Apple or Microsoft. For two, All this shuffling creates a ton of volatility across the entire market. And 3, the fundamental balance of the market, the thing we all rely on, suddenly gets thrown completely out of whack. And you have to understand, this might not be just some temporary storm that blows over. An event like this could fundamentally change the entire market landscape, maybe for good. It could be a new market reality. For decades, the playbook has been pretty simple. IPOs are good. They add fresh, exciting companies and bring new value to the market. That's the old reality. But what we might be staring down the barrel of is a totally new reality. One where these mega IPOs are so big, they don't add to the market, they drain it. They force this huge zero-sum game of shuffling money around that's already there. So, all of this leaves us with one final, really critical question. For the last 20 years or so, we've built a financial system that leans heavily on these automatic passive index funds for its stability. But are those very structures, the ones we built for stability, actually prepared for the arrival of trillion-dollar startups? That's a question every single investor might have to answer, and maybe sooner than we think.